She's been photographing weddings for 4 years. Revenue of $28,000 per year. Equipment costs, travel, software. She claims $40,000 in deductions and reports a $12,000 loss each year. The losses offset her husband's W-2 income and reduce their household tax bill by roughly $3,600 annually. The IRS audits her in year 4 and reclassifies the photography as a hobby, arguing there's no genuine profit motive given the consistent losses. Result: 4 years of disallowed deductions, $14,400 in additional tax, plus interest of $4,200 and a $2,880 accuracy penalty. That $12,000 annual tax benefits became a $21,480 liability. The hobby loss rule is codified in IRC Section 183. The fundamental rule is this: if an activity does not have a primary profit motive, its deductions are limited to its income. It cannot generate a deductible loss. The IRS presumes a profit motive if the activity produces a profit in 3 or more of the previous 5 consecutive tax years. For horse breeding, training, and racing, the standard is 2 out of 7 years. The profitability presumption is rebuttable, meaning the IRS can still challenge an activity even if it's been profitable, but 3 profitable years in 5 is your strongest protective fact pattern. The IRS uses a 9-factor test from Treasury Regulation 1.1832 to determine whether an activity has a profit motive. These factors are the manner in which the taxpayer carries on the activity, the expertise of the taxpayer and their advisors, the time and effort expended, the expectation that assets used in the activity will appreciate, the taxpayer's success in similar activities, the history of income or losses, the amount of occasional profits, the taxpayer's financial status, and elements of personal pleasure or recreation. No single factor is determinative. All 9 are weighed in context, but some carry more weight than others. The manner of operation factor is often the most impactful because it's the most controllable. A taxpayer who operates their activity in a business-like manner, maintains separate books and records, maintains a separate business account, advertises consistently, tracks metrics, consults with industry professionals, and changes failing methods to improve profitability, demonstrates a profit motive regardless of outcome. A taxpayer who doesn't maintain records, commingles funds, and has never made a documented effort to improve profitability looks like a hobbyist regardless of whether they believe they're running a business. The financial status factor examines whether the taxpayer has other income sufficient to subsidize the activity. A high-income W-2 employee with a consistently loss-generating side activity benefits from the losses at a high marginal rate, exactly the pattern the hobby loss rule was designed to prevent. An auditor examining a photographer with a salaried spouse earning $180,000, where the photography losses offset that income at the 28% bracket, will scrutinize the profit motive intensely. The more the activity appears to function as an income offset mechanism rather than a genuine business effort, the more aggressively the IRS pursues reclassification. Personal pleasure or recreation in the activity is the factor that makes photographers, musicians, artists, writers, and travel bloggers particularly vulnerable. If the activity is one that many people engage in purely for enjoyment, and you happen to also generate some income from it, the IRS begins the analysis with skepticism. This doesn't mean these activities can't be businesses. It means the business-like operation evidence must be stronger and more explicit than it would be for a less lifestyle-adjacent business. A photographer with a business plan, a marketing budget, a target revenue model, and documented efforts to reach profitability looks like a business. One who shoots weddings when asked and spends the rest of the year on personal projects does not. The IRC Section 183E. Election, sometimes called the safe harbor election, allows a taxpayer to postpone a determination of profit motive until the end of the 5th year of the activity. You file Form 5213 and essentially tell the IRS, hold off on evaluating this until year 5. The benefit is time to establish profitability. The risk is that the statute of limitations for auditing those years is extended as well. The election is most useful for a business that has strong early indicators of viability but won't reach profitability for 2 to 3 years due to startup costs. Document the 9 factors proactively rather than reconstructing them during an audit. Keep a business plan, even a simple 1-page document, from year 1. Document your research into how to improve profitability. Retain evidence of advertising and marketing efforts. Note time spent on business activities in your calendar. Consult with industry advisors or coaches and retain those records. These are not large administrative burdens. They are simple habits that transform an ambiguous factual record into a defensible one. The standard is not perfection. It is evidence of genuine intent to generate profit. Generating a profit in at least one of every 2 to 3 years, even a modest one, is the most direct protection against hobby classification. If your deductions consistently exceed your revenue, actively work to either reduce expenses or increase income to achieve a profitable year. Breaking even or generating a small profit in year 3 is far more valuable as a legal defense than the marginal tax benefit of a $5,000 loss. Some practitioners specifically advise clients to generate a profitable year when they can, even by timing revenue and expense recognition to reset the profit motive presumption. The hobby loss rule catches business owners who operate casually, document nothing, and rely on consistent losses to reduce household taxes. If your activity generates personal pleasure, has occasional or no profit years, and offsets significant W-2 income, you're in the IRS's target profile. Build the documentary record from day 1. Generate a profitable year when you can. File Form 5213 if the activity won't break even quickly. For a broader view of what else on your return triggers IRS scrutiny, the Audit Triggers video covers every pattern that flags returns for review.